All right, and we are live. Good afternoon, good evening, or good morning, depending on where you're joining us from. And welcome to another episode of the AI Circle brought to you by the iFlip YouTube channel. I am your host, Aaron Yoon. I'm the product manager here at iFlip. And joining me, of course, is none other than our chief investment officer, Kelly Korshak. Welcome, Kelly.
Hello, Aaron. Hello, everybody.
Hi. We're just going to jump right in, and we're having kind of an uncharacteristic month in June. This will be the last AI Circle in June, and it's an uncharacteristically bullish month. Wouldn't you say, Kelly? Usually June isn't this crazy of a bull run.
Different times.
Yeah, crazy
Different
world we live in.
times.
Anyway, before we can get to any of our market updates and explanations for how the AI is interpreting the market, we have to go through everyone's favorite preamble, the disclosures. So bear with me as I read this. Disclaimer: iFlip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make buy, sell, or hold recommendations for any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure that the iFlip portfolios that you select are suitable for your investment account before trading in a live brokerage account. Now, with that out of the way, I am going to pass it back to you, Kelly. And let's get our market updates for the past 2 weeks and wrap up the month of June for us.
All right. Hello, everybody, and welcome again to the AI Circle, Wednesday, 3:30 Pacific time. And that's, of course, is the June 28th. All right. Another day where the Dow Jones still muddles along just off of recent highs from about a week ago. Let's kind of summarize first the first 2 quarters of the year, as of course Friday will mark the end of Q2 23. The market is up about 14% on the S&P 500 this year, up another only about 4.5% on the Dow Jones this year. The Russell 2000, about the same, 3.5% is all. And of course, the stellar 7 incredible stocks that represent over 50% of the NASDAQ 100 is up a whopping 34% on this year. So we see the NASDAQ has clearly led the way for the market to advance this year. It has literally dragged the S&P higher, and to a smaller extent, the Dow Jones. In last week's AI Circle, and probably in an AI Circle even prior to that, we commented on these 7 incredible stocks that have skyrocketed the NASDAQ to be up over 34% on the year, literally dragging the other indices higher. So that is the world we live in today, where the S&P 500 is being dragged up by literally the 7 stocks. So we all know that. But I think we have to put some things in context of what's going on around the world as well. So we kind of know that the backdrop is much higher interest rates, around 5%. We see that literally from everything from ETFs that pay that to bank CDs that pay almost 5% on literally 3-month or 6-month CDs at a bank, and you can get that in the money markets as well nowadays. But I think the major context is what's going on around the rest of the world. Well, the rest of the world has very similar interest rates now. And I think it bears looking at some of the foreign markets to be able to get context of what's going on. So let's start with just our own S&P 500, and let's look at it year to date, like we are here. And we see that here's the S&P's rise of about 14% year to date from literally the 3rd of January, which is the first trading day of the year. Look at the NASDAQ. Same thing, however, it's up 34%. If I were to look at the Dow Jones, we've already see that, but the Dow Jones is up only 4% on the year. But let's look at the Hang Seng Index. This is a representation of the Hong Kong market. Down on the year. Interesting. Let's look at it in context from COVID. There's COVID here. And obviously the Chinese market for Hong Kong is much lower. We know the reasons why, but let's keep this in context. Let's look at the Nikkei. A different story. If we look from COVID, the Nikkei is doing well. However, if you look in 2022, where our markets were down significantly, 20% on the S&P, the market for the Nikkei 225 was actually up in 2022. Let's take a look at the German DAX. The German DAX is the German equivalent of the S&P 500. And if we look, 2022 was a down year for the DAX, but not much. And lo and behold, the DAX has come off of its lows in 2022 or 2023 as well, and it has gone back to its old all-time highs. Because if we even see COVID, it made its highs very similar to America, and it is sitting literally on the highs, whereas the American market's 10% off its highs. Let's look at this. This is the French CAC market. And if we look at this, very similar. The market has just recently made an all-time high. However, it is only barely above its COVID highs. And therefore, what we saw again in 2022, Europe didn't do as bad as America. And Europe, of course, has done better in 2023 than the S&P 500. It's up literally 17%. Let's take another look at something else very important. This here represents, let's see if I can find it. Where's the FTSE? I don't have it close, but the FTSE is the UK market, and the FTSE is trading also just barely off of all-time highs. However, again, it's not much higher than prior to pre-COVID. So around the world, the markets are up and being dragged up by these same technology stocks that trade on their markets as something called an American Depository Receipt. So what I'm pointing out here, folks, is that in many cases, the worldwide markets are also being influenced by technology in this country. And it's literally dragged the world markets higher. But the same kind of cancer seems to exist all around the world. The higher interest rates, higher inflation has added really deep value to technology, which has literally brought up the worldwide basic stocks kicking and screaming. Let's look at the 30-year bond. Now we know we still have an inverted yield curve. Sorry, this is not the 30-year bond. This is the FTSE I was looking for. As you can see, just off of its all-time highs and not doing very much on the year for the FTSE. It's literally just flat. But I want to show everybody this, the long-term bond market. This is what's happened to the bond market since 2022 and even right after COVID. Interest rates made a high again in price right after COVID and has been going south ever since. The market is stabilized here at about 3.9% or so on the 30-year bond, about 3.75% on the 10-year bond, which is right here. Why are these things significant? Well, they're significant for a reason that interest rates really are a driving force with all price action around the world. Interest rates are literally, long-term interest rates are literally at their lows in prices and very close to their highs in yield. So this here is, for example, a 2-year note. A 2-year note is literally close to its lows, yielding the most it's yielded in, goes back over 10 years. I can tell you it's been 20 years since this note has yielded 5%. And that's kind of where we're at, folks. The yields on short-term interest rates are extremely high relative to the stock market, which means this: over time, these interest rates are actually going to have to go higher, which means lower in price. And we already see this in the Federal Reserve signaling that further rate hikes, not cuts, are in store for the United States and around the world going into the third and fourth quarters. One thing I want everybody to note: the third and fourth quarters generally can be problematic, as we all know about September and October being very problematic months for the stock market, especially given that the recession that we all thought, including myself, that was going to occur did not occur yet, either in the first and now second quarter, which means where are we going to go from here? In the totality, I think what's happened, and I have to admit that I have been wrong, the market up till now, feeling that the market was overpriced early on, and it even remains more so overpriced now. But what I didn't account for, and even the AI didn't account for, is the fact that all the money that is still sloshing around out there, that when the Fed started to signal that they may have a pause, the money sloshing around became very emboldened, and it invested back into the market. At this point, I think there's a move marginally higher that is coming because people feel that they've missed this rally, and now they feel I must get in now. That is not normally a good sign. That's normally a sign that you would fade as a contrarian. But at the end of the day, the market is up 14%, and it's been a good first half of the year. So now, given that I've been off on the year for approximately 10%, and that now we're going into the second half of the year, it's not like we would be looking to buy dips, or that the AI will suddenly change around, or an algorithm will pull us in or out of a new buy position. All we can say is that AI right now, given the fundamental data, still looks dismal. And perhaps, and this is my opinion, and I will opine this in this way, that the market is probably just delayed what I thought, and many people thought, would occur 2, 3, 4 months ago, till maybe 2, 3, 4 months hence. So we will see how that unfolds. If we look around the world and we were to take a quick look at the foreign exchange rates, I think we see something going on here too. Here's the US dollar. And the US dollar, as you can see, has come way off its highs, down to a 102 area. But I can tell you, in my career, when I saw this first trade in early 2000, this was also the price. The dollar is really in the same price today as it was 23 years ago. A little bit higher, a little bit lower. The dollar is not falling apart. Even though you may see some commercials this way, the dollar is not falling apart. It has fallen down from all-time highs to basically where it's been in a range for over 20 years. So let's make sure we don't try to downplay the dollar or its value, forgetting political thinking. Remove that from your mind and just think, hey, it's still in a range. So the dollar isn't giving us an indication that we should do one thing or another. And by the way, if that's the case, then we would see this to be true in the individual currencies. And lo and behold, it is. This is the, let's get the euro currency right over here. The euro currency, which of course made lows down to literally almost 95 cents, 90.95 of a euro buys you $1. Now, of course, the euro has rallied from this low back to 109. Most of my life, I remember the euro being more around 130. And you can kind of see it if we go back historically, that these were prices that occurred years and years ago. 10 years ago, the price was 135. I remember it as high, is in the 140s areas many years ago. Here we go back here, back to almost about 12 years ago. So again, the dollar, at least against the euro, is much stronger. So the reason I point this out is because there's a lot of gold bugs out there. I'm not against gold in here, but if you're going to look at gold, you have to look at it in the context of the dollar. And what I'm seeing is not telling me that I have to go and run out and buy gold. Take a look at it. Gold hit its high of around 2080, kind of made another attempt to go to that high, and basically is falling off, as you can see, all the way through now. Let's go further up. Here's our little rally and fell off. There we go. So you can see gold is really having trouble at the $2,000 an ounce area. It's now about $1,900 an ounce. The question is, where does it go from here? I'm not a gold bug. I don't think owning some gold in a portfolio is a bad idea, but keep it no more than 3 or 4%. And don't buy gold just because you think the dollar is going to hell in a handbasket. I don't believe that for 1 second, but gold is only an investment for 2-3% of your portfolio, just like a cryptocurrency is. Let's take a quick look at something I find really deeply interesting, natural gas. I think everybody can admit these are the lowest prices for natural gas I can kind of remember in my lifetime. And when I see things like this, I'm generally trying to look to be a buyer. The question is, where? What's a good price to own this type of commodity if you feel that there will be a day in the future where natural gas might have its day? Maybe we will keep our gas stoves and gas ovens and allow our country to be able to use this natural resource the way it should be used, because right now it is literally at all-time lows. As an old commodity trader, this would be something deeply interesting to me to hold and to roll, because over time, this is something that could double, triple, or quadruple in value. The question is, how do you do that play? I'm looking into it and see if I can somehow put this kind of a product into our portfolios. So there's the general rundown of the worldwide markets. Let's quickly go back to stocks and take a look at some of those. So let's look at the banking stocks, because people will always have an interest in banking, because I only have a couple more minutes before Aaron takes over. And one of the stocks I kind of like right now is Charles Schwab. It's a bank, but it seems to be the one that has dropped the most and is doing its best to recover in the light of other stocks and banks like Bank of America that have dropped since the banking crisis, but have yet to recover. Take a look at Bank of America. It's basically right around $1 higher than where it dropped to. JP Morgan doing a little bit better. It has recovered from its fall of the banking crisis, and it's basically closer to its highs. JP Morgan is a notorious bank for not getting into trouble when the trouble hits the fan, because it's so conservative. And as anybody has a Chase account, you don't get paid on it. So you have to move your money to another bank if you really have extra cash that you want to get a yield on. But the one that's really surprising me is Goldman Sachs. Goldman Sachs, I would love to own this stock, but it's just not performing. It's just not making it. The banking crisis came and it shot the price down. It tried to rally, but now guess what? It's closer to its lows. I'm staying away from Goldman, and I've been a big believer in Goldman forever, but I don't like the price action. And so I can't get solidly behind banking right now. The only thing that shows, and we all know what it is technology. Technology is leading the way. There is no ifs, ands, or buts about it. There is a FOMO going on with these products. Here is Apple. Apple, I think if everybody knows, I remember when it turned into a $1 trillion company about a year and a half ago. And today we are now closing in at $3 trillion company. This company actually, with its market cap, is becoming essentially the 5th largest country. It's a company, but it's behaving like a country in terms of its capital value. That, to me, doesn't feel good. I'm a believer in Apple. I believe everybody should own some. However, I don't like it here. I don't like it here. This is a stock that was 120 earlier this year, in the 120s. I can't seem to buy it at 190 and think it's a bargain. So for me, I can't get into these things, and I am not going to reach for a stock that has gone up 70% in 1 year. Just can't do it. So that leaves us with some of the 5 to 7 stocks, as you can see what they are. The Amazons. If I Google through them, you'll see how they've all gone up enormously. Meta, Microsoft, Netflix, Nvidia, Tesla. These are stocks that have just kept and held the entire market higher. That's where we are today. Where we go in the third quarter, I'm expecting the market to muddle around for a couple of months, but I certainly don't want to go into September thinking we're going to get a big rally then, when September is always a pivotal month, generally going opposite to the direction of the market that it went to going into September. So I'm going to sit pat personally on the side, let the AI do its work, focus in on the dividend types of stocks, make sure we get paid to be in the market this year, but take as little risk as possible. And with
Thanks,
that, Aaron?
Thanks, Kelly. Appreciate that. I was very interested in what you said about, holding gold and treating it also, treating crypto similar to gold and having it be a few percent, maybe 3 or 4% of your portfolio. Similarly, I think a lot of people, like what's becoming very popular now, at least it's being advertised as something that's really a big deal and very popular, are CDs. I keep getting emails about it all the time myself, because they're going as high as 5%. Some, I think, even cracked the 5% to like 5.25% or something like some crazy rates like that. I don't remember ever seeing rates that high for a CD. So and this is a question that we've gotten several times. Are CDs actually worth it now, considering they're being paid out so much, and it's a little bit late to be jumping on the bandwagon for tech stocks, as you said? So what do you think about CDs at this point?
I'm a believer at this juncture in time. What is wrong if you don't know what to do on up, if you haven't participated in it? Do you get in it now and take all the risk of what those 7 stocks have done by buying, for example, the S&P that's up 14%, when you know that if something, God forbid, comes into the market that is negative, and there's many things out there that we all know. I mean, for example, possibly a conviction of Donald Trump, or an impeachment of Joe Biden, or a problem with an Apple phone for the Apple 15 that'll come out in the next month or so, or 2 months. So there's all kinds of problems that can disrupt both politics that will affect the markets, or companies that can affect the markets. Why would I want to be in the stock market sometimes when I can get 5% if I just go over to the bank for the next 6 months in a CD? That way, 6 months from now, you can make a decision if that's a good yield for you or not. But here's what that means, that CD means. That means if, say, you have a spare $100,000, you can go over to the bank, and 6 months from now, you get a 6-month CD. They're going to give you $2,500. That's what it's worth. Is that a good deal? Yeah, it is. The problem is that when you put money in a bank, you tend to keep it at the bank, and then when it matures, you might buy another one, and maybe that next one will also be 5%, and then you'll get another $2,500 after 6 months. The option and the alternative is to keep it in your trading account and simply, if you have money there, and simply buy the near or the what is it, the USFR, which are money market funds that are yielding, say, 4.5. That way, so it's not $2,500. You'll get $2,250 instead. And for me, for the convenience, I'd rather just keep my money in the markets and buy those things, which are, by the way, tradable. And if I need the money, I can do it tomorrow. Whereas a CD, you are penalized in the event that you might need the money at the bank. And just a heads up, 5% is a good yield, but I remember those things paying 15. So that is just a matter of age. And I think anybody that heard that number, if you see 15% on a CD, I highly recommend going out and buying one. 5%, you can get that in the market. So no real added value to me, but for the first time, yes, I can see why that's interesting. And by the way, folks, that's the money on the sidelines that everybody talks about that one day will come into the market. The difference is nowadays, 5% is a reason not to go in the market. If it's at 0.5%, of course, that's money that can go into the market. But at 5%, that money's going to have some stickiness because you're being rewarded to not go in the market.
Gotcha. What was that ticker symbol that you said again? That is
USFR, United States Federal Reserve, or it's offered by, I think, is it an iShares product? And it'll offer you about 4.5. Yep.
4.5. I mean, I think I'm with you there. I actually didn't know. So I learned something today too, everybody. I didn't know what that was. I didn't know that ticker symbol existed, but I'd rather, for the convenience, I would probably happily sacrifice 0.5% for the convenience, right? If it's that close. But obviously, if we ever hit those crazy numbers where you hit 15 or anything double digits, that's a different story. We did have one last question before we get to the trivia question for this evening. And this is very, I think, basic, very, very quick. So we did get this question submitted via email. It says, what is the difference between a common stock versus a preferred stock? I think we've seen these words on the charts or on the news every now and then, and I don't think it's common knowledge. So can you explain this for us in layman's terms? What's the difference?
Sure. Generally, the main difference between a common stock and a preferred stock is that a preferred stock has no voting rights. It gives you something else, but it doesn't give you voting rights. Common stock, which is generally what you are buying when you go to the market. However, there are preferred shares that are offered on the New York Stock Exchange and other places that you can buy. But a common stock offers you voting rights. A preferred stock does not. A preferred stock is generally offered to clients when they are raising money. When a company goes to raise money, they are offering a preferred status to a certain class of stock, a preferred stock. And that status means that should something go wrong with the company and they have a preferred stock, it means that after the debt holders are satisfied, because remember, debt always gets paid first. So if you give a loan to a company, you're going to be one of the first people in line. If something happens to that company and they sell their assets, the first people in line are debt holders. They will get paid first. The second people in line would be preferred shareholders. They would get any money left over after all the debt has been paid. And the final people in line are the common shareholders, which means if there's anything left after the debt is satisfied, if it's satisfied, or the preferred stock shareholders are satisfied, then the common shareholders will get whatever's left. It's a level of security that a lot of investors want when a large company in particular is going to raise cash.
Gotcha. So preferred means you're basically sacrificing voting rights in order to jump the line and get in front of the line in terms of should anything go wrong, being able to recuperate losses.
Correct.
Very simple. Thank you so much. Now, with that out of the way, it is trivia time, everybody. And I will say that people must be prepping for the holidays or something, because this weekend is the holiday weekend, because we do have a much thinner attendance tonight than usual. But we will still give away our prize, and I don't know if people are going to be missing out. So your odds are better than they've ever been to be winning this trivia prize. What is the trivia prize tonight and going forward? It is a Amazon gift card in the amount of $25, which, if you ask me, might as well be cash, right? Someone you know would be willing to trade you cash one for that, if not yourself. In addition to that, if you we will be in touch with you, and in order to you can actually double your winnings if you post about it and share your winnings, share that, tag us on whatever social platform that you want, and talk about how you won $25 just for showing up and participating and answering a trivia question correctly. So you could win as much as $50 in Amazon gift cards if you answer this question correctly and you're a qualified winner, which I'll talk about in just a second. So hopefully you're all ready. What is the trivia question for tonight? And we have the trivia question for tonight is, under which president did the S&P 500 perform the best? Okay, so I'll give you, wish I could play a little Jeopardy music here, but under which president did the S&P 500 perform the best? So if you've been listening to this AI Circle show passively, kind of like a podcast, now's the time to take a moment, stop what you're doing, get on in here and participate in the trivia question. We're looking for the president under which the S&P 500 performed its best. Now, depending on how you interpret this question, I will give you a hint. There could be two possible answers that we accept. So that's all I'll say. That's the extent of the hint. And before we get to any answers and winners, let me just make sure and do a little bit of housekeeping, how to qualify for the prize if you submit the correct answer. It's not enough that you just get the correct answer. You also have to be a qualified winner, which means that you need to show that you're invested in at least one iFlip Smartfolio. So if you're declared a winner, then you get to just email us at mailbag@iflipinvest.com. Show us a screenshot of your account or send us your account number, whichever, and we'll verify that you're invested in at least one Smartfolio, and then send you your prize right away. After which, if you engage with us on social, we'll double your winnings. So this is worth as much as $50. Now, give you a little bit of time. What are our answers? Well, like I said, we have a very thin crowd tonight. I guess most people are prepping for the holidays, and we do have a winner. Our winner for tonight is, there we go, Teresa Seibenek. I hope I'm saying that correctly. Teresa Seibenek. And we also have, which is the correct answer, and we also have the other correct answer, depending on how you interpreted the question, which is Obama. Okay, so we do have two correct answers here. Kelly, how come this question has two possible correct answers? Let me bring up the question back, and please explain for us how could that be?
Well, because a president if he serves 2 terms, then you could say that during his presidency, over that 8-year period, the market went up X amount. If a person could also have a 1-year period where it was actually the very best for the first 4 years, but if you added the second 4 years, it's not. That is why the answer for all 4 years would be Bill Clinton, but the answer for the best 4-year period would be Barack Obama, who edges out Bill Clinton by 1%. And just so everybody understands what that was, is Bill Clinton, under his 8 years, the market went up 150%.
Wow.
In Barack Obama's first term, the market went up 80% in his first term, which was about 1% higher than Bill Clinton's first term. So both answers are correct depending on how you define the question. And we define the question that way, so there could be 2 winners.
Absolutely.
And so in this case, Teresa looks like she got the right one with Bill Clinton for the all 8 years, but someone I see, Nancy Chadwick, did Obama, which definitely did have the very single best 4-year return on the stock market was under Barack Obama, 80% higher.
Absolutely. And we left it that way, and we left it up for interpretation on purpose because we wanted to, if there were both answers submitted, we wanted to reward both answers. So both Teresa and Nancy, you are our double winners for tonight. Both of you have qualified to receive $25 each on as an Amazon gift card. And all you have to do is, once again, email us at iFlip. I keep saying that. Mailbag at iflipinvest.com. Show us your screenshot of your account or your account number, or just give us your account number, whichever, and we'll verify you're invested in at least one smartfolio. If you're not invested in a smartfolio, now's a very good time to get rewarded for doing so. Just hint, hint. And
Buy something. Buy something, Teresa. I see your thing.
And we will email you a $25 Amazon gift card right away. Okay, congratulations to both of our winners tonight. If you enjoy this kind of content, then please consider subscribing to our YouTube channel and hit that notification bell, because I'm sure you're going to want to participate in these types of trivia contests. Again, we do this every second, third, and fourth Wednesday of the month. So we will take a break. Next week is holiday week, so most people are probably going to take a break anyway. But we will see you back on July 12th for another episode of the AI Circle. We did get a couple of questions. Let me just answer these questions real quick before we sign off for the evening. Some questions. This is Jean Chadwick, signed in under my wife's email account. Thank you for qualifying that, Jean. Sorry we called you Nancy. You would just still email us under whichever email, but we will send the Amazon gift card to the email of the iFlip account that you show us, just for consistency. That is one thing that I did want to clarify. Your YouTube account email might not be the same as your iFlip account email, but we're going to go by your iFlip account email. So how long do I have to get invested and still win? Teresa, I mean, we usually don't have an issue with this because people are anxious to just get their prize winnings. But I would say, at your earliest convenience, there's no statute of limitations on our prizes. So whenever you're ready, we will honor it. Okay, you can take as long as you need. We'll just put it that way. So long as we hope that we see you back here. We hope that we've given you enough valuable content that you continue to like and subscribe and show up and engage with us. But take your time. We will honor it. This is on record. You can quote us at any given time to say, hey, I won. I'm finally invested. Give me my prize. Okay. So no time limit. Okay. Hopefully that takes care of a little bit of housekeeping. And yes, you're very welcome, Teresa. Thank you so much for joining us this evening, everybody. Happy 4th of July for those of you that are in America. And we will see you in 2 weeks. Good night, everyone.
Good night, everyone. All the best. Happy holiday.